Welcome to The Explainer. Today, we're cracking the code on one of the greatest legends in investing, Warren Buffett. We're going to use a really deep academic analysis to figure out what the data really says about the secrets to a success. Genius or just lucky? For decades, that question has been at the very heart of a massive debate in finance. Is Buffett's incredible track record the result of some unique genius, or is he basically just the winner of a giant cosmic coin-flipping contest? You've probably heard this one before, right? The classic argument from efficient market theory says that if you get millions of people flipping coins, hey, someone is bound to get heads 50 times in a row, just by pure luck. Maybe Buffett's that guy. But Buffett himself had a great comeback for this. He argued that it's no coincidence that so many of the stock market's biggest winners all came from his intellectual village of value investing. So, instead of just debating, we're going to follow the evidence. This whole explainer is based on an academic deep dive that systematically breaks down Berkshire Hathaway's performance to find the repeatable factors behind it all. So first things first, let's look at the hard evidence of that record-breaking performance.
Okay, so before we get into the how, we really have to wrap our heads around the sheer scale of what he accomplished, because honestly, the numbers are just staggering.
Let's start with this number, 0.79. From 1976 to 2017, Berkshire Hathaway pulled off a Sharpe ratio of 0.79. Now, a Sharpe ratio is basically the key measure of how much return you get for the amount of risk you take, and the higher the number, the better. Now, here's where that 0.79 really comes to life. Look at how it stacks up on this chart. It nearly doubles the risk-adjusted return of the entire stock market. And I mean, it just leaves the average mutual fund in the dust. This isn't just good, it's on another level.
And if you thought that was impressive, check this out. This table shows just how unique that performance really was. When you compare Berkshire to every single stock and every mutual fund with a track record over 40 years, it comes in at number 1. First place. Not top 10%, not even top 1%. Literally number 1. But, and this is a huge but, it was not a smooth ride to the top. Not at all. Just look at the dot-com bubble. While the market was going crazy, Berkshire was down a gut-wrenching 44%. Most investors would have been fired or just given up. Buffett's ability to stick with his plan through these massive downturns is a really big part of the story.
So that begs the question, right? How did a very good, but maybe not totally superhuman, risk-adjusted return lead to one of the biggest fortunes in history? Well, that brings us to our first big revelation, the power of leverage.
Okay, so the first piece of the puzzle is his methodical, consistent use of leverage. In simple terms, he was using other people's money to make his own investment bets even bigger.
And we're not talking about just a little bit here. The paper estimates that Buffett operated with a leverage of about 1.7 to 1 on average. That means for every dollar of his own, he was investing about $1.70. Now, this is great for boosting returns on the way up, but, and this is crucial, it also juices the risk. But here's where the real genius kicks in. It's not just that he used leverage, it's how he got it. He wasn't just walking into a bank for a loan. He had these incredible, cheap, and stable sources of funding, especially that famous float from his insurance businesses. The premiums customers pay up front that Berkshire gets to invest for its own profit.
I mean, just think about this for a second. The cost he paid to borrow this money was on average 3 whole percentage points less than what the U.S. government was paying to borrow. He was literally being paid to hold and invest billions of dollars of other people's money. That is a competitive advantage that is almost impossible to beat.
Okay, so we've got cheap, stable leverage. That explains how he magnified his returns. But the next big question is, what was he actually buying with all that cash? And that leads us to our second revelation, the secret ingredients of his stock selection.
When the researchers dug in, they found this incredibly consistent pattern. Buffett's public stock picks systematically focused on companies with 3 key things in common. First, they were cheap, classic value stocks. Second, they were safe, so they had low volatility and risk compared to the market. And third, they were high-quality businesses, profitable, stable, growing. You get the picture.
And you know what's so cool? This lines up perfectly with what the man himself has been telling us all along with his folksy wisdom. This quote, it's not just a clever line, it's literally a description of the formula. Quality merchandise, that's the high-quality factor. When it is marked down, boom, that's the value factor.
All right, now let's put these 2 big pieces together, the leverage and the stock picking, because this is the real aha moment. This is where we finally crack the code.
So in the finance world, alpha is the holy grail.
It's the part of a return that you can't explain with known market factors. It's the magic, the secret sauce. It's the quantifiable measure of pure genius. And for decades, Buffett's alpha was the stuff of legend.
And here it is. This is the aha moment of the entire analysis. When you use the standard models, you just can't explain Buffett's performance. His alpha is huge. But the moment the researchers added in factors for his preference for safe and high-quality stocks, poof, his alpha almost completely disappeared. It became, in their words, statistically insignificant.
So, the big takeaway here is that his legendary performance wasn't some unexplainable magic. It can be largely boiled down to a powerful, repeatable formula: the systematic application of cheap leverage to a portfolio of cheap, safe, high-quality stocks.
So what does deconstructing a genius like this mean for the rest of us? What are the practical takeaways from finally uncovering the formula?
Well, the paper leaves us with 3 really clear lessons. First, that markets aren't perfectly efficient. These kinds of factors can be exploited. Second, that all those academic strategies can actually generate real-world profits if you do it right. And third, and this one's a big one, we all need to be realistic. One of the wealthiest people on the planet did it with a Sharpe ratio of 0.79. Aiming for a lot more than that is probably a recipe for disappointment.
And that leaves us with a final thought to chew on. Does knowing the formula make Buffett's half-century of success less impressive, or does it actually make it more so? Does it highlight the incredible iron-willed discipline it took to find a winning strategy and then stick with it through thick and thin for over 50 years?